The stock market is a complex system that plays a crucial role in the global economy. At its core, it is a marketplace where securities, such as stocks, bonds, and other financial instruments, are bought and sold. Understanding how it works involves exploring its structure, participants, mechanisms, and functions. At its most basic level, the stock market provides a platform for companies to raise capital and for investors to earn a return on their investments. Companies issue shares of stock to raise funds for expansion, research and development, or other business needs. Investors buy these shares, effectively becoming partial owners of the company. In return, they expect to benefit from the company's growth and profitability. The stock market is composed of several key components: stock exchanges, brokers, investors, and regulatory bodies. Stock exchanges, such as the New York Stock Exchange, NYSE, and the Nasdaq, are platforms where stocks are listed and traded. These exchanges facilitate the buying and selling of stocks, providing a centralized location where transactions can occur. Brokers act as intermediaries between buyers and sellers. They execute trades on behalf of their clients, who could be individual investors, institutional investors, or other entities. Brokers are essential for providing access to the stock market and offering advice or research to help investors make informed decisions. In recent years, online trading platforms have also become popular, allowing individuals to trade directly without a traditional broker. Investors are the entities that participate in the stock market, and they come in various forms. Individual investors are private people who buy and sell stocks for their personal portfolios. Institutional investors include entities like mutual funds, pension funds, and hedge funds, which manage large sums of money and often have significant influence on market movements. Regulatory bodies, such as the Securities and Exchange Commission, SEC, in the United States, oversee the stock market to ensure fair and transparent operations. These regulators enforce rules and regulations designed to protect investors and maintain the integrity of the market. They require companies to disclose financial information, prevent insider trading, and ensure that trading practices are conducted fairly. The process of trading stocks begins with a company deciding to go public through an initial public offering, IPO. During an IPO, a company offers shares of its stock to the public for the first time. This process involves underwriting by investment banks, which help set the initial price of the shares and manage the sale. Once the shares are issued, they are listed on a stock exchange, where they can be bought and sold by investors. After the IPO, the company's shares trade on the open market. The price of a stock is determined by supply and demand dynamics. If more people want to buy a stock than sell it, the price tends to rise. Conversely, if more people want to sell a stock than buy it, the price tends to fall. This price fluctuation reflects investors' perceptions of the company's future prospects, financial health, and overall market conditions. Stock prices are influenced by a variety of factors, including economic indicators, company performance, and broader market trends. Economic indicators such as interest rates, inflation, and unemployment can impact investor sentiment and influence stock prices. For example, a strong economy may boost investor confidence, leading to higher stock prices, while economic downturns can have the opposite effect. Company performance is also a critical factor in stock price movements. Investors closely monitor earnings reports, revenue growth, profit margins, and other financial metrics to gauge a company's health and future potential. Positive earnings results or successful new product launches can drive stock prices up, while disappointing performance or negative news can cause prices to drop. Broader market trends and global events can also impact stock prices. Political developments, natural disasters, and changes in international trade policies can create uncertainty and volatility in the markets. For instance, geopolitical tensions or economic crises in major economies can lead to significant fluctuations in stock prices worldwide. In addition to stocks, other financial instruments are traded on the stock market, such as bonds, options, and futures. Bonds are debt securities issued by companies or governments, offering regular interest payments to investors. Options and futures are derivative instruments that derive their value from underlying assets, such as stocks or commodities. These instruments can be used for various purposes, including speculation, hedging, and risk management. The stock market operates through a system of order execution and clearing. When an investor places a buy or sell order, it is routed to the stock exchange, where it is matched with a corresponding order. Once a trade is executed, it is recorded and settled through a clearing process. This involves the transfer of ownership of the stock and the exchange of payment. Clearinghouses play a crucial role in ensuring that trades are settled smoothly and that both parties fulfill their obligations. Market participants use various strategies and tools to manage their investments and take advantage of market opportunities. Fundamental analysis involves evaluating a company's financial statements, management, and industry position to determine its intrinsic value. Technical analysis, on the other hand, focuses on analyzing historical price patterns and trading volumes to predict future price movements. Investment strategies can vary widely, from long-term buy-and-hold approaches to short-term trading strategies. Long-term investors typically seek to build wealth over time by investing in fundamentally strong companies and holding their stocks for extended periods. Short-term traders, such as day traders and swing traders, aim to profit from short-term price movements and may make frequent trades based on technical analysis or market news. The stock market also plays a role in wealth creation and economic growth. By providing companies with access to capital, it enables businesses to invest in new projects, expand their operations, and create jobs. As companies grow and become more profitable, they contribute to overall economic development, which can benefit society as a whole. However, the stock market is not without risks. Stock prices can be volatile, and investments can fluctuate in value. Investors can experience losses if stock prices decline or if companies perform poorly. It's important for investors to conduct thorough research, diversify their portfolios, and consider their risk tolerance before making investment decisions. In summary, the stock market is a dynamic and multifaceted system that serves as a crucial component of the global financial system.